All right, I think we'll go ahead and get started. Well, I want to thank everyone for registering and participating in our employee tax retention credit update. It was shared with us a few days ago that some changes in the legislation. There were some COVID credits that was still able to be retroactively received. I studied it for an afternoon and then reached out to these professionals from Smith Howard to help me put this together. So what I want to do is just, since there's just a few of us this time, I'm going to ask everyone to mute their mics. You can leave your video on. If you do have questions during the presentation, if you'll put it in the chat during the presentation, the presenters can look at that and not be interrupted, and they can address that as they go. But if you want to, you can you're more than welcome to hold that. We'll have a Q&A session at the end. So anyway, I want to thank Scott Whalen and Nicole Davis from Smith Howard to putting on this presentation for us. This is the second time that we've done this, and we've had quite a few people participate in not only the live version, but also downloading the video a little bit later. Like I said, we were unaware that some of the stuff, the credits for the COVID money was retroactive. That was a change that happened after we had all thought the COVID money had been put to bed. And so we had moved on, but we had a local business tell us that they were dealing with their accountants that was able to actually impact their business significantly. So we decided to put another presentation together. So before I go too far down the line with that, I want to introduce Scott Whalen, who is a partner with Smith & Howard. He has 14 years with the company, as a member of the manufacturing, distribution, and technology teams, and works with clients across entertainment, hospitality, staffing, and transportation industries. And we have Nicole, who is a senior tax manager. She's 9 years with Smith Howard, and she works in services for companies, nonprofits, real estate, and construction firms. So I'm going to pass it to Scott and Nicole. We appreciate you putting this together for us, guys.
Yeah, and I'm going to go ahead and share my screen, Scott, and you can jump in.
Yeah, well, absolutely. Thanks for that intro, Scott. We're happy to be here. And as Scott mentioned, as you have questions as we go through these slides, there's a lot of information on the slides. We'll try to keep everything very practical, very high level. But as there are relevant questions, we're happy to dive in and address those as we move forward. So the purpose today is just to get a basic understanding of the employee retention tax credit and how it might impact your business. We went through, Nicole, if you want to go to the next slide. So that's us. Scott's already done an excellent introduction on that. So when we distribute these slides later, we'll have our contact information, and we're happy to answer any follow-up questions that you may think of later. Very briefly, Smith & Howard's headquartered out of Atlanta. We serve clients across the country, and we've been, following all of this COVID-related legislation since day one. And as Scott mentioned, this is kind of the last bit. The PPP is done. The EDLs are done. A lot of the healthcare provider funds are done. So the employee retention credit is really the last opportunity, and we do have some additional time here to claim these credits. So today we're going to, again, talk about the credit very briefly at a high level. Then we'll talk about the two different paths to qualifying, which are a gross receipts test, very mechanical. I won't say straightforward, but it does basically, it falls onto math, and it's either an in or an out. Then we'll talk about the partial shutdown test. This is where we really have some nuance. We have some gray area and a lot of competing opinions about what qualifies and what doesn't. So our goal today will be to spend some time talking through that, some key determination factors to help you make an informed decision about that. And last, we will just briefly talk about how to calculate the actual credit once you kind of get in the door. And then we'll work through how to claim those amounts and other kind of considerations related to PPP interplay, your tax return and how it impacts that, and kind of talk about how Smith & Howard can help. And then at the end, we'll close it out with any questions that come from the crowd. So why are we talking about the employee retention credit today in 2022 when, as we see on this slide, it's been around since March of 2020? And the key reason is that when these first came out, we had two choices. We had PPP, which was 100% of our payroll, fully tax-free, and then we had employee retention credits, which were not tax-free and were 50% credits. And you can only pick one. And lo and behold, many people chose the PPP program because that was a much better benefit for them. Now, fast forward to the beginning of 2021, and Congress, as the COVID pandemic continued to occur, they said, hey, we need to supercharge this. We need to make this available for more businesses. And so then they unlocked the ERC for businesses that had taken the PPP-1 or the PPP-2, which really changed the game in terms of who was eligible to take these credits. And so that was kind of the first phase where there was really a lot of discussion about this. And then over the last year, there's been some IRS guidance, and we've kind of started to understand the rules around this. So people are getting comfortable on what fact patterns qualify and how to approach these credits while maintaining a solid tax position. A couple brief definitional things here. We don't need to get into them too much, but one of the key things is when we talk about employees, we're only talking about full-time employees. There's some specific math around whether or not your 2019 employee count was either 100 or 500. And just to be clear, it's only full-time employees. Go ahead now, Nicole. So we have this credit and it's available for calendar year 2020 and for 2021. It's the same credit, but there are different rules for each year. The 2020 credit is limited to basically $5,000 per employee. The 2021 credit is much more powerful. It's up to $7,000 per employee per quarter for 3 quarters. But the key distinction there is that the rules for qualifying in 2020 or 2021 are different. So we're going to get into those differences here shortly. So I mentioned earlier, there's 2 options for us to qualify. One is just a pure mathematical analysis on our gross revenue for our business. So Nicole will talk about that in a little bit, but basically that's the easy path. If we qualify for that, we're in and we're moving on. The second way to qualify is that our business was impacted by some sort of government shutdown, meaning there was a CDC order, an OSHA order, a city order, a state order, some sort of impact to our business that required us to change how we do business. And we're going to talk about the ways that doesn't have to just be our office. That can be our suppliers. That can be other areas outside of our home office that we do business. So there's a broad swath of places and in ways that we can be impacted here. And we'll talk about that more. But that's really where the facts and circumstance for each business are critical to understanding how you may qualify. Then I mentioned earlier the headcount limitation. So if you have, and these are all 2019 headcounts. So if you have under 100 full-time employees in 2019, you qualify for the maximum amount and there are no restrictions on the wages that you've paid to your employees. If you're between 100 and 500, your credit calculation will be very different between 2020 and 2021. And if you're over 500, you have the same limitation in both years. And so for any very large businesses over 500 people, you only get this credit when you pay people not to work. Not normally a great business decision. So not a lot of people have qualified via paying people not to work. So really this credit is targeted for businesses with less than 100 people for 2020 and less than 500 for 2021.
Okay, so as Scott mentioned, the first way to qualify is the gross receipts test. As he said, this is the much cleaner way to qualify and the easier way to track and substantiate. There are 2 different ways for 2020 and 2021. The 2020 qualification is that we need to see a 50% gross receipts reduction as compared to the same quarter in 2019. This is a quarterly test, so even if you didn't qualify in Q2, you could qualify in Q3 or Q4. So we absolutely need to look at every quarter for the businesses involved. Another point for the 2020 reduction is once you hit that 50% reduction, you can continue to take the credit until you hit up to 80% of 2019 gross receipts. So in our example, the Q1 gross receipts reduction is 49%, but they didn't hit 80% of gross receipts until Q3. So they can take this credit for Q1 and Q2. So that can be a big opportunity for people. I was actually just looking at a client who only had the 50% gross receipts reduction in Q2, but they're able to take the credit through Q4 because they did not hit the 80% until that fourth quarter. So a lot of opportunity there if you had one quarter that was down significantly.
And obviously 50% is a big hurdle, but it is, again, quarterly. So we've had a lot of client fact patterns where they were actually up 20% year over year, amazingly. But in Q2, they had a huge drop off. So even if you're up or flat year over year, you really do need to think about this on a quarterly basis. And it's a little bit easier when we get to the 2021 qualifications.
Absolutely. So for 2021, they made things a little easier and less stringent. Instead of having a 50% reduction, we only need to see a 20% reduction as compared to the same quarter in 2019. Something that people get confused by is in 2021, we are still comparing to 2019. We do not compare to 2020 gross receipts. We skip over that year for our comparison purposes. So as you see, for 2021, this 83% for Q1 wouldn't qualify, but this Q2 74% would qualify. However, there was a new rule implemented in 2021 that said you can use the prior quarter's gross receipts to qualify you for the subsequent quarter. So in that case, a lot of times what we see is in Q4 2020, as you see here, there was a 20% decrease. So we can use that to qualify you for Q1. And then subsequently, if you had less than a 20% decrease in Q3, we can use Q2 to qualify you. So even if you're hitting these gross receipts reductions just in one quarter, it's very likely that you'll be able to use that to qualify you for more than one quarter. So those numbers can go up significantly. Something that's also important is aggregation rules do apply. If there's over 50% common ownership, there are some nuances to that we won't get into, but kind of rule of thumb, if there's more than 50% common ownership among businesses, we have to aggregate those. So if you have more than one business and you own it more than 50%, we need to use the gross receipts from all businesses involved. That also applies to headcount. And so we just have to make sure we're covering all of our bases there. So how do you determine gross receipts? It's a little different for for-profits and tax-exempt employers. For-profits is pretty standard, run-of-the-mill, what you would consider gross receipts: your total sales, less returns and allowances, your investment income, your other income, your net capital gains or loss. And so it's adjusted for your basis. For our tax-exempt nonprofit employers, it's not as intuitive. So again, it's your total sales less your returns and allowances. It's also your investment income. However, for your tax-exempt employers, it's not your net capital gain or loss, it's your gross sales price on stocks. So that can swing things significantly for our tax-exempt companies. And we've seen actually quite a few companies qualify just based on the fact that they sold quite a few stocks in 2019 and did not sell the same level of stocks in 2021. And they had no other decrease in any other sector. They just had a lot of, they may have changed up their portfolio or something else to cause that.
And one quick clarification is that we think about the other COVID relief programs, right? The Paycheck Protection Program had a necessity requirement, right? We had to say, we need this loan for X, Y, and Z reason. The employee retention credit does not have that same provision. So this mechanical test, it really has no requirement that it's, because of COVID or due to COVID or anything else like that. The rules are very straightforward. If you meet this mathematical test, you're in, and there's no need or necessity or any other attestation required once you meet that test.
Absolutely. And also for our tax exempt employers, it's based on when you receive a pledge. It's not necessarily based on when you receive the cash of that pledge. So that can be a really big difference as well. So those get a little more complicated and, a few more calculations involved, but it can come up with a big credit back to the employer. Something else we hear a lot, how do tax exempt employers get a tax credit? It's because it's a payroll tax credit, and our nonprofits do pay payroll tax. They don't pay income tax. So just because you might be a nonprofit or involved with one, this is still a great opportunity.
So now we come to our best friend, the partial shutdown test. And here's where really careful consideration of how your business was impacted is necessary. So if you just go and do an internet search for ERC, you will see people on all ends of the spectrum here. There's some people that say 99% of the businesses in America qualify, no questions asked. And then there's other people that say, unless you're a bar, a nightclub, or any of these other businesses that were truly, chains on the doors, locked and closed, they don't qualify. And the real answer obviously lies somewhere in between. So what we're doing here when we think about partial shutdown is comparing the law with IRS regulations. And IRS regulations are not the law of the land, but they help us interpret that law. So the IRS gives us about 25 to 30 total examples that we have to determine what qualifies as a partial shutdown. So it's very clear the IRS believes that there are examples of businesses being impacted, yet not qualifying under the suspension. So we'll dive into a couple of examples here, but the main takeaway is that this really requires careful analysis. You can't just get a one-size-fits-all answer. And even some businesses that do very similar things in similar industries, depending on where they're located, and they might be in a different county, it all can vary case by case. So the takeaway is you need to talk to a professional. We'd be happy to be those folks to really determine how this path might serve your business. So getting into a couple specifics here, the IRS tells us, if a business is allowed to be open and they just voluntarily say, hey, we're not comfortable operating in this environment, we're going to shut down, or we're going to modify how we do things, but we're not required to, that's not going to cut it. The IRS gives an example of a car dealership that has a decrease in revenue and a decrease in demand because all their customers are under stay-at-home orders, and the government's told people don't go out unless it's necessary, but the car dealership is allowed to stay open. So that's where there's a demand side, and they say, look, you weren't impacted. Just because people didn't come doesn't mean that you were impacted by the government order. And then there's a big catch-all that basically says, if you are required to close, but you were able to basically do the same work at home, they say comparable, then that's not necessarily that you were suspended or that you were closed. So those are kind of the three big categories of orders that do have an impact, but not at the level to qualify you for this partial suspension test. So here's a couple of examples that do qualify. And before we get into the detail, just one quick note is that when we're talking about your business being impacted, it's not an all or nothing test like this gross receipts is. You can really look at different business lines. So if you sell 3 different products, or you provide 3 different types of services, or you provide the same service in 3 different types of locations, you can divide up your business segments and figure out, well, this one, we did this service in hospitals, and that was totally shut down because they were elective procedures, even though the rest of our business wasn't impacted. Well, if that one segment was a significant part of your business and it was impacted, that opens up the rest of your business to qualifications, subject to those other rules we talked
Right.
about.
And
Nicole,
to jump in, yeah, I was gonna say, it doesn't even have to be a really significant part of your business. It just needs to be what the IRS calls more than nominal. So, and based on their narratives, which are not super in depth, they tend to define nominal as about 10%. So if you have a line of business that was 10% of your business in 2019, that was effectively shut down for 2020 or part of 2021 before government orders were lifted, then we can look into this partial shutdown. And as Scott said, just having that one line shut down will qualify all of your business lines for the credit.
And so here's one example of that. You have a manufacturing plant, operates in Georgia and California. The Georgia plant never had any restrictions, operating at full capacity the whole time. California plant, it was required to stagger shifts, space people out. It used to run 24 hours. Now it can only run 12 hours a day for cleaning. Well, if that California operation is at least 10% of our total production, and that's a more than nominal portion of our business. And the California portion being modified by government order would qualify the entire business. So that's where we can look at different local jurisdictions, not just the company as a whole. There's a couple of very obvious ones that I mentioned earlier, like bars, music venues, and movie theaters. I mean, those are pretty easy. Where you, again, really requires careful consideration is when you had a portion of your business that really wasn't able to be done remotely. And if you're thinking to yourself, well, there was one business line that we couldn't do because we could be open, but we couldn't do it because of X, Y, and Z. That's the trigger. That's where we want to have a more in-depth conversation about what that qualification would look like.
Absolutely. Okay, so how do you calculate the ERC and how do you claim it? As we said earlier, for both 20 and 2021, it's based on gross wages that you pay to your employees. What we can also include in this is health insurance paid by the employer. For 2020, as we said earlier, it's for all wages paid if you have less than 100 full-time employees in 2019. And then for 2021, it's if you have 500 or less full-time employees for 2019. The gross wages and health insurance requirements or eligible payments does not change. Those are the same. It's just which wages qualify. So if you do have more than the 100 or 500, the only wages that you can take the credit on are wages paid to employees who aren't working or providing a service. Something that we have seen is employers paying employees full-time when they perhaps can only do their job part-time in a remote capacity. So maybe it's a gym and they might have over 100 full-time employees in 2020, but they're paying their employees full-time, but they can only do part of their job from home. They can't effectively do strength training or spin classes or something like that. So the employer can say, well, they could do 50% of their job, but we're paying them for 100%. So in that case, you get the credit for the other 50%. So it's not a cut and dry, you only paid people not to work, or you only paid people to work. If you paid people and they were working less than at full capacity and it was due to a government order, that would also qualify. So something else to consider.
Yeah, and I think the takeaway here is that they may be thinking, well, how do I figure all this out? I mean, the good answer is that you don't have to. Where you really come in is figuring out, well, how was I impacted, and does this potentially rise to having being under a suspension order? And if so, then you talk to someone like us and we'll help you figure these things out and determine what wages are eligible. Are there categories of employees we aren't thinking about? Because again, there are a lot of, there's way more rules than we put on this slide, but it's very we strongly recommend that you do not go out there and try to calculate this yourself, that you work with a qualified professional to make sure you're capturing everything that you're eligible for.
Absolutely. So how do you claim the money after you've determined that you qualify and the amount of credit that you are deserved? So the credits are claimed by filing an amended 941 for the relevant quarter that you have the credit in. So if you get credits for Q2 and Q3 of 2020, then you'll need to amend your second quarter and third quarter 941s to claim the credit. Unfortunately, these can't be e-filed, so they have to be paper filed. So there's a little bit of a timing, a time wait for these refunds, but they will come. The IRS is making their way through these quicker than they were. So we're seeing these credits come in faster now. And there's not a huge time push to get these done. 941s can be amended up to 3 years after originally filing. So you have time to assess your situation. You have time to calculate and file these. But I will say the further away we get from 2020, the further away we get from 2021, it gets harder to remember our narrative and establish it and pull government orders. So, we want to assess this as quickly as possible.
And to put a date on that, so if we're saying, the most common time that you were impacted by COVID was the second quarter of 2020. You filed that payroll return in July of 2020. So that gives us until July of 2023. So a little over a year before we, hit the runway to claim these credits. So the last considerations here are, this is a cash refund, right? So when we amend this payroll tax return, we're not just saying, give me a little bit of credit over the next 20 years. The IRS is sending you a check. That's great. But the catch there is that check is a taxable income item, meaning you may end up paying 20 to 40% of that credit amount in taxes, depending on how you're organized. As we mentioned, there's some limitations about how this wage deduction is impacting on what you claimed on PPP and on some other tax incentive items. So the key takeaway here is that you really need to work closely with a tax professional or somebody who's can review your tax return and help you figure out when to report the impact of these credits. Smith & Howard works with clients on both the study side, determining eligibility, as well as on filing the amended returns. So we're able to assist on both sides of that equation.
Absolutely.
As we mentioned, this is a lot. There's, this may have seemed like it was very in-depth. We promise there are even more rules, but that's what we're here for, to help you understand this. So that covers basically the bulk of what we think the key takeaways are. If there are any questions here today, we'd be happy to dive in and look at your specific fact patterns.
Scott, just one comment. I know several situations where companies that are not our clients needed help and they came to us, to you and Nicole, and you did it on a project specific basis, and it was not threatening or disruptive to their CPA relationship.
Yeah, that's absolutely right, Alan. Thanks for that. And so we across our service lines, we're willing to work with folks and respect existing relationships. And as I mentioned before, there are some CPA firms that take an approach that, you better be a bar or a restaurant, otherwise I don't think you qualify. And we clearly think there's a very wide middle ground. But again, you can't just run off from the hills and say, well, hey, I had to wear a mask that one time, so I must qualify. You really need to take a nuanced look at it. And we're happy to be that kind of neutral, unbiased advisor to tell you, what we think your risks are, what we think your qualifications are. And we're happy to do that without stepping on, any existing relationships. So that's a great question, Alan.
Great.
And just to piggyback off of that, a lot of firms aren't doing this at all. They just aren't comfortable with it. But thankfully, we've had the capacity to be able to, me and Scott have had the ability to spend a lot of time learning these rules and learning these calculations. And we've been lucky to have the resources to support us for that. So, we certainly are happy to help anyone with that. And Something a little bit different about us that you won't see, sometimes credit providers are going to charge you a significant portion of the credit for their fee. We're also not doing that. So if you feel like someone's fee is really high, feel free to reach out to us and see how that feels and what our opinion is on that.
So I'm going to take this video and send it out. Is it okay to send it with your and Scott's email addresses with that?
Absolutely.
Absolutely.
Perfect. All right. There's a few people in here. Does anybody have any more questions for the presenters? There was nothing that came up. I was monitoring the chats as y'all were going through that. So there was nothing that came up there. So if not, then we'll close out here. And thank you, Scott. Thank you, Nicole. I appreciate it. Alan, Marvin, thanks for helping get all this set up. Again, this is being recorded. We're going to send it out probably after it gets edited tomorrow morning. We'll send this out with your contact information. If anybody has any questions, they can reach out to you directly.
Absolutely.
Okay, well, that sounds great. Thanks for having us.
Thank you. Y'all have a good afternoon.
You
All
too.
right. Bye now.